All right, let's jump straight in. Today, we're really getting into the engine room of global commerce. We're doing a deep dive on the infrastructure that, well, makes everything move. Logistics, real estate,
Yeah.
and resource material. It's the Q3 2025 supplemental reports from Prologis. I mean, they're the undisputed heavyweight champion in this sector, right?
Absolutely. And for you listening, if you're trying to really get a handle on the health of the global supply chain, looking at Prologis is kind of like getting an X-ray.
That's a good way to put it.
So our mission here is to quickly dissect what their Q3 numbers are really telling us. About market resilience, maybe where some cracks are showing, and crucially, what they seem to be betting on for their next decade of growth. Because believe me, it's becoming about more than just warehouses.
Okay, let's kick off with those headline financials then, because they are, well, they're pretty staggering.
Yeah.
Core funds from operations core FFO per diluted share hit $1.49. That's a solid 4.2% jump over Q3 last year. And operationally, they set a new record, signed 62 million square feet of leases in one quarter.
That kind of velocity is just, wow. It tells you demand is still incredibly strong, far from slowing down.
It really speaks to how critical their business is, doesn't it?
It does. And just to put that scale in context for you, Prologis owns or has investments in roughly 1.3 billion square feet.
Billion, with a B.
Yeah. Spread across 20 countries. They've got about 6,500 customers. Primarily, the B2B logistics firms, the big retail and online fulfillment giants.
So basically, if you buy something online, chances are it spent some time in a Prologis building.
Pretty likely.
Yeah. Now, that global footprint is vast, but the revenue, it's not exactly spread evenly, is it? We should probably note the geographic concentration.
That's right. That's just the reality of these high-barrier logistics markets. 85% of their annualized net operating income, their NOI, comes right from the U.S. markets.
85%. Wow.
Yeah. Compare that to Europe, which is about 9%, and Asia's only 1%.
Yeah.
So while that global reach definitely offers diversification, the immediate financial story for Prologis, it's almost entirely dictated by the health of the U.S. consumer and U.S. trade flows.
And within that key U.S. market, the operating metrics just scream stability. Average occupancy for their share stayed incredibly tight. 94.7% for Q3. Very tight.
What does that occupancy figure really tell us about the competitive landscape?
Well, I think it tells us two main things. First, their locations are gold. They're near the major ports, the big metro areas. You just can't replicate them easily.
Irreplaceable.
Exactly. And second, new supply is either way too expensive or basically impossible to build in those areas where demand is highest.
Okay.
And that leads directly to their customer loyalty, which is pretty robust. Retention rates held strong at 77.2% for the quarter.
So tenants aren't leaving?
Not really. I mean, think about it. Moving a massive distribution operation, it's hugely costly, disruptive.
Yeah, difficult.
So they just aren't leaving these premium spots if they can help it. And that's smart business from a Prologis' side too, right?
Yeah.
Because they've quite intentionally diversified their tenant list.
Yeah.
You always worry a bit with REITs about one huge customer pulling out.
Oh, absolutely. That lack of single customer risk is a real core strength you see in the financials. Their top 25 customers, together they make up just 21.2% of the occupied square footage.
Okay, so not overly reliant on any one group?
Not at all. And even their single biggest tenant, which is Amazon, no surprise, there accounts for a really manageable 4.9%.
4.9%.
Yeah. So even if one of the giants shifts strategy, it's not going to crater their overall NOI. It's well spread out.
Okay, good. Let's tackle those numbers that sometimes trip people up when they first look at REITs. That dance between net earnings and core FFO.
Right. The confusing part.
We saw core FFO increase 4.2% to $1.49. Solid. But then net earnings per share actually decreased by 24.1% down to $10.82. Why the huge contradiction?
Okay, yeah. This is really the crucial concept you have to grasp when analyzing these firms. Net earnings uses GAAP accounting, right?
Standard accounting, yeah.
Yeah, which requires them to deduct these pretty substantial non-cash charges. Specifically, it's depreciation and amortization of the real estate assets.
So paper losses on buildings that are actually appreciating.
Exactly. Think of it like, well, imagine a business owns a fleet of really valuable trucks. They're holding their value, maybe even going up, but the accountant has to write them down on paper every year as they age.
Got it.
Core FFO basically strips out those non-cash charges. It gives you a much cleaner a truer picture of the actual recurring cash flow being generated by the operating business.
So that 4.2% rise in core FFO is the real signal.
That's the green light, yes. It signals underlying operational health, increasing profitability, regardless of what the GAAP net earnings shows on paper.
Okay, that makes sense. And understanding that FFO growth makes the performance of their existing portfolio even more critical. Let's look at cash out. Same-store NOI growth. That's how their properties owned for over a year are performing.
Yeah.
It was 5.2% in Q3. Now, that's solid. But when you look at the huge rent increases they're achieving, why isn't that same-store growth figure, dramatically higher?
That's a fantastic critical question. It really gets to the mechanics. It's because of what you could call a blending effect.
Blending effects.
Yeah. Rents on these big leases typically roll over every, say, 5 to 10 years. So while they might sign a brand new lease today at a massive, maybe 50% increase over the old one,
Right.
the overall same-store NOI for that building is an average of all the leases in that building. That includes leases locked in years ago at much lower rates that won't expire for maybe a few more years.
Okay, so the 5.2% is the average uplift as the older, lower rent leases gradually expire and get replaced by new ones at today's market rates.
Precisely. It shows that incremental lift. It takes time for those big rent bumps on new leases to fully filter through the entire portfolio's average.
Gotcha. And those current market rates, as we said, are still phenomenal. Let's talk pricing power. The net effective rent change, that's the increase over the whole term of the new lease, was 49.4% in Q3, almost 50%.
Incredible. And the immediate cash rent change, the jump on day one, was 29.4%.
Nearly 30% cash increase on rollover. That's extraordinary in any real estate sector, isn't it?
It absolutely is. It confirms that the supply-demand imbalance is still severe, still enduring, but, and this is where we have to be analytical, we are seeing a clear sign of moderation.
Moderation, okay. Explain that. Is that a sign of weakness creeping in?
I wouldn't call it weakness, not yet anyway. More like normalization. If you look back, say, a year ago, Q3 2024, their cash rent change was 44.1%.
Okay, 44.1% then versus 29.4% now.
Exactly, dropping from over 44% under 30%. That's a pretty significant deceleration.
Right.
Now, look, 29% is still fantastic. Don't get me wrong. Any landlord would kill for that.
Yeah.
But it does suggest maybe one of two things.
Which are?
Either some competitive new supply is finally hitting the market in certain areas, giving tenants a few more alternatives, or maybe the general economic environment is starting to cool tenant demand just a little bit from those absolutely feverish peaks.
So to watch then.
Definitely. But overall, their total revenues still confirm that sustained strength. They were up from about $2.0 billion in Q3 last year to $2.2 billion this Q3.
And that's driven almost entirely by rental revenue, right?
Almost entirely. Rental revenue was about $2.05 billion of that $2.2 billion total.
Okay, so that kind of sustained cash generation, even with some moderation in rent growth, doesn't just sit there. This leads us right into how they're investing that money. Capital deployment.
Right, building the future.
In Q3, they stabilized $604 million in projects. That means completed, generating income. And they estimate that created about $169 million in value.
And look at their forward strategy. It seems heavily de-risked. They started $446 million in new development projects. But the crucial detail here is that a huge chunk of that 63.9%, almost two-thirds, were designated build-to-suit.
Build-to-suit, meaning they have a tenant lined up already.
Exactly. They have a contract signed with the specific tenant before they even pour the concrete. That takes a lot of the market risk out of it.
So they're not just building speculatively and hoping someone shows up.
Much less so on the starts, it seems. They're fulfilling customized, pre-secured demand for a lot of it.
And meanwhile, they're barely acquiring existing buildings, right? Acquisitions were pretty modest, $48 million. They actually sold more, $71 million in dispositions.
Yeah, that reinforces the idea, I think. In their core high-barrier markets, it's just probably too expensive to buy existing stabilized assets right now.
Cheaper to build.
It seems it's cheaper and definitely more value accretive for them to utilize their massive land inventory, build it themselves.
And that land inventory, wow. This might be the single most important strategic point in the whole report.
I think it is. The total estimated build-out potential, the TEI of their entire land portfolio, their land bank, It's a staggering $42.3 billion.
$42.3 billion worth of future potential development.
That's their physical long-term runway for growth. It provides this competitive moat that, frankly, just cannot be replicated by competitors trying to patch together land parcels in these super constrained urban areas.
That scale is hard to comprehend. Colossal.
Right?
Maybe the most intriguing strategic pivot they revealed, the thing that really jumped out, is the sharp focus on digital infrastructure, data centers.
Ah, yes. The big...
The CEO has been very clear. They are actively investing to support this, well, unprecedented demand for high power.
This is where things get really interesting. It feels like a shift, doesn't it? From purely logistics real estate towards, well, almost energy real estate.
How so?
The headline figure is just stunning. Prologis now has secured, or is in advanced stages of securing, 5.2 gigawatts of utility-fed power capacity.
5.2 gigawatts.
Specifically allocated for data center opportunities on their land. We are talking massive, massive electrical requirements.
So the future value of a logistics park might not just be about loading docks.
It might be about its proximity to a beefy utility substation. Seriously.
What does that mean operationally, though?
Yeah.
Managing 5.2 gigawatts of power capacity. That's vastly different from being a landlord worried about roof leaks and security gates, isn't it?
Oh, completely different ballgame. It requires deep relationships with utilities, expertise in grid upgrades, power distribution, maybe even generation down the line. Who knows?
So how are they positioned for that?
Well, they're leveraging their prime locations. The same spots that are great for distribution often have existing access to high-capacity utility grids. It's synergistic in that way.
Okay.
And you see this focus clearly in the specific development capacities mentioned in the report. They highlight significant solar and energy storage capacity megawatts concentrated in places like Southern California.
55 megawatts there.
Right. And New Jersey, New York City, 38 megawatts. Also globally, Germany, Mexico. These are their highest barrier to entry logistics markets.
So they're linking energy strategy directly to that scarce land.
Exactly. They seem to be turning that scarcity of space into a potential scarcity of power, which they control. It's a really fascinating strategic move.
Okay, let's quickly just confirm the financial strength backing up these huge plans. The balance sheet looks incredibly resilient, right? Total available liquidity is around $7.5 billion.
Yeah, about $7.5 billion, plenty of dry powder. And just as importantly, they are extremely well insulated from rising interest rates, which is crucial right now.
How so?
Well, their debt to EBITDA ratio is pretty conservative at 5.0x, but the real protection is in their debt structure. Their weighted average interest rate across all their debt is only 3.2%.
Wow, 3.2% in this environment.
Exactly. And the weighted average term, the length of those loans, is exceptionally long at 8.3 years.
So they've locked in low rates for a long time.
For a very long time. They don't face major refinancing cliffs in the near term, unlike many others. This lets them keep executing on that massive development pipeline without intense financial pressure from interest rates.
Okay, so wrapping up the key takeaways from this deep dive for you listening, Prologis showed, 1, real operational resilience, super high occupancy, strong retention.
Rock solid operations.
2, sustained financial strength backed by that growing core FFO metric we discussed.
Yeah, the key profitability measure.
And 3, this immense, seemingly de-risked future development potential anchored by that $42.3 billion land bank.
And you see their confidence reflected in the fact they actually raised their 2025 guidance. They nudged up the low end of their net earnings forecast, and they raised the range for cash same-store NOI growth to between 4.75% and 5.25%.
So they're feeling pretty good about the near term.
Seems so. Their CEO, Hamid Moghadam, stated very clearly he thinks the current market setup, limited new supply pipeline plus sustained e-commerce demand, is actually one of the most compelling he's seen in his, 4-decade career.
That's quite a statement from someone who's seen a few cycles.
It certainly is.
Okay, but as always, we want to leave you with that final provocative thought. Something to chew on that ties the traditional logistics core to this emerging future.
Right.
They have that $42.3 billion future development pipeline, mostly traditional logistics space, presumably. But they are actively allocating massive utility capacity, 5.2 gigawatts, specifically for data centers.
So the question for you to ponder, thinking about the next decade, is pretty simple but profound. If power capacity becomes the most constrained and therefore the most valuable resource on that land, how quickly will the demand for high-powered digital infrastructure shift the very definition of prime logistics real estate? Will it move from being fundamentally about space proximity to ports, highways, population centers,
The traditional factors.
to being fundamentally about power. Will the most valuable plots in that huge $42.3 billion land bank end up being defined not by their proximity to the port, but by their proximity to the nearest utility substation?
Space versus power. A fascinating question for the future of this whole sector.